But you also know that as a percentage of income, that debt load has mostly been manageable. High debt, but guess what? We can afford it. But now some of that is beginning to change. For more on both the housing and car stories, let's bring in Diana Olick and Phil LeBeau. Diana, let's start with you. What are you seeing in one particularly, call it, fragile part of the mortgage market?
Well, Brian, the mortgage delinquency rate, has been really low for nearly a decade. And aside from a very brief jump at the start of the pandemic before those government forbearance programs, it's now sitting at just 3.98% overall, that according to the Mortgage Bankers Association. Compare that to just over 10% back in 2010 during the subprime crisis. The mortgage landscape, I'm saying, is quite healthy, with one major red flag. FHA loans, their delinquency rate, while always higher, has been rising recently, now hitting 11.3%, and that is the highest since 2013. Here's why.
All of the stresses in life we're seeing right now, a little bit of softening in the job market. We're seeing big jumps in insurance premiums as a result of all of the hazards out there, whether they be wildfires, hurricanes, what have you. All of that leading to some stress.
FHA attracts first-time buyers with lower incomes and credit scores. The FHA down payment requirement is just 3.5%, and borrowers can carry higher debt compared to their income, that's so-called DTI. And that's because FHA borrowers have to pay mortgage insurance. But FHA recently lowered that insurance premium, which brought in more borrowers. That resulted in higher credit levels of the entire program, but that debt to income is still very high, and that's because of inflation and affordability, high home prices. The MBA is also reporting a big jump in buyers of newly built homes going to FHA. It's gone from 10% just a few years ago to 30% today. And I'll say it again, Brian, because of high home prices.